Hi, do you work for the production company? And did you find out that some of your production assets have been fully depreciated, but you still use them? Well, what's the problem with it and how to correct it? Let's find out in this video where you'll learn how to deal with the changes in accounting estimates and correction of errors in line with IAS 8. I am Sylvia of IFRSbox.com and I help people understand and simplify IFRS. I have created 2 courses and tons of free IFRS materials, so you're welcome to check them out at IFRSbox.com. So, why are your assets fully depreciated if you still use them? Well, the problem is that their useful lives are incorrectly estimated, and in fact, there are 2 possible choices that you can follow, and let me first brief you a bit about them. The first option is that you can apply revaluation model to your assets instead of cost model and revalue these assets to their fair value regularly. In this case, you would deal with a change in accounting policy in line with IAS 8. I am not in favor of this option, and I'll tell you why in a minute. The second option is to review estimated useful life of your assets and deal with a change in accounting estimate in line with IAS 8. And in this video, I'll show you exactly how to do this. So let's take a look at the first option, application of revaluation model instead of a cost model. You are allowed to do this, but please be aware that switching to revaluation model means to change your accounting policy, and you should have a good reason to do it. In fact, revaluation model for your production assets might not be that suitable, and I think you would take the wrong pill to your problem. Why? Because your production assets are not really recovered through the capital appreciation on the market, but in the production of other assets. And also, it might be very difficult, if not impossible, to determine the fair value of used production assets on the regular basis. Well, in fact, application of revaluation model to your production assets might become your big pain, well, with some exceptions. And if you're interested, you can read more about that right here in my article. So maybe the second solution is much better. Well, that is to review useful lives of your assets. So you should really look at the useful lives of your assets regularly, and if you think you're going to use them longer than their remaining useful life is, well, change your accounting estimate. According to standard IAS 8, you should treat a change in accounting estimate prospectively. Well, it means in the current and future periods with no restatement of previous periods. In this case, if the useful life is revised, then your annual depreciation changes, and the new revised depreciation charge is calculated as the carrying amount of your asset at the revision date divided by the remaining estimated useful life of that asset. Well, I'll show you the numbers in a minute. Okay, but now I can hear you saying, well, but what if the carrying amount is 0? In other words, what if the assets are fully depreciated and we still use them? How can we change the accounting estimate if there is nothing left to depreciate? Well, in this case, let me remind you IAS 16, the standard about property, plant, and equipment. This standard requires you to review useful lives of property, plant, and equipment at least at each financial year end. So that means you should have done that in the past. Well, but the truth is that many companies just forget it. So if this is your case and you forgot to review useful lives of your assets in the past, then there is an error as defined by IAS 8, and this error results from not applying IAS 16 properly. So what to do with this error? Well, first of all, ask yourself, is this error material? In other words, would this misstatement influence the decisions of the users of the financial statements if omitted? Well, the concept of materiality is defined in the standard IAS 1, so check it if interested, but it requires judgment and you should have some idea whether this particular error might be material for your company or not. So if the error is material, then you really need to correct it retrospectively, not in the current reporting period when you discovered it, but go back. You should do it either by restating comparative amounts for the prior period presented in which the error occurred. Well, this is the case when the error happened last year, basically. Or If this error occurred before the earliest period presented, then you should restate opening balances of assets, liabilities, and equity for that earliest period presented. Well, again, we'll solve this example in a minute. If the error is not material, then you just correct it in the current reporting period. So now you get a picture, and let's take a look at some numbers. So here's our case study. Volvo plc CFO works on the closing of the year 2005's accounts. She performs the review of machines used in the process of a production and assembly of Volvo's products, cars, and finds out the following. As a result of maintenance actions taken in the beginning of 2005, Volvo's stamping machine's useful life will be extended by 2 years, from 3 to 5 beyond 2005. The carrying amount of Volvo's painting machines is 0, but Volvo's production manager plans to utilize them in the next 2 years, 2006 and 2007. Volvo's CFO also found out that in 2002, significant amount of small components in painting machines was replaced, and this replacement extended machines' useful life by 2 years. However, Volvo did not reflect the situation in its financial statements in 2002. Based on the financial information below, advise Volvo how to reflect these two cases in its financial statements as of 31st December 2005 and ignore tax effect. So here, we have certain financial information related to these two types of assets, while these assets are grouped here for the sake of simplicity in this example. Let's solve it one by one. So first, stamping machines. Here, we are in 2005 and machine's useful life was extended as a result of actions taken in this year, current reporting period. So in fact, we're dealing with the classic change in accounting estimate, and we need to account for it prospectively in the current and future reporting periods with no restatement. So let's make some calculations. Cost of these machines was 800,000 of whatever currency it is. Original annual depreciation charge was 800,000 divided by 6, which was the useful life in the beginning. And it is 133,333 per year. Accumulated depreciation as of 1st January 2005, or the current year, was 2 times annual charge because Volvo charged depreciation in 2 years, 2003 and 2004, so it is 266,666. And that means that the opening carrying amount is 800,000 less 266,666, and that gives us 533,333. Well, why did we calculate the opening carrying amount as of 1st January 2005 and not closing one as of 31st December 2005? Well, because you need to account for change in accounting estimate both in the current and future periods, and as the changes on asset happen in the beginning of 2005, it is appropriate to adjust annual depreciation charge for the current period too, right? So, remaining useful life in the beginning of 2005 was 6 years, because the question says that the extended useful life is 5 years beyond 2005, and plus we need to take 2005 into account too, and that makes 6 years. Revised annual depreciation charge is therefore opening carrying amount of 533,333 divided by 6, which is 88,889. Volvo simply recognizes the new depreciation charge as usual, debit profit or loss, or cost of another asset if applicable, and credit accumulated depreciation account. Well, sure, Volvo must disclose appropriate information about the change in accounting estimate in the notes to the financial statements. Let's see more complicated stuff now, the painting machines. Well, this is exactly our problem. Painting machines are fully depreciated, but will be used for another 2 years after 2005. Well, here, Volvo did not review useful lives in the past. Well, that's error because of failed application of IAS 16. And it seems that useful life of painting machines was significantly extended 3 years ago in 2002 as a result of replacement of certain small components. So here we can identify it quite reliably when exactly the error happened. Well, but in reality, the situation might not be that obvious and it may require some judgment too. Now, let's assume that this error is material and Volvo needs to correct it retrospectively. Well, if it would not be material, Volvo would simply do nothing because there's nothing left to depreciate. First of all, let's see how it looked like in the beginning of 2002. Well, that's the period when the error happened. Well, let's assume everything was okay until then. The cost of painting machines was 700,000 and they were acquired in 2000, so the depreciation had been charged for 2 years, 2000 and 2001. Original annual depreciation charge is calculated above as cost divided by 6. Well, that's the original useful life. And it is 116,667. So accumulated depreciation in the beginning of 2002 is 2 times 116,667, and that's 233,333. Well, therefore, the carrying amount before this error was the difference between the cost and accumulated depreciation, which is 466,667. Now, to make everything clear, I set up a simple table here where I will perform all the calculations year by year, starting with 2002 and finishing with 2005, the current period. In these columns, let's calculate what Volvo actually booked in the past, while numbers coming from the original remaining useful life, which was 4 years in the beginning of 2002. That's 6 years in total, less 2 years already in use. So here, the depreciation charge on the straight line basis is still the same as before, cost divided by 6, which is still the same 116,667. Why is that? Because Volvo did not change anything and we must continue with what we originally calculated. In the second column, there is a carrying amount at the end of the period, calculated as the carrying amount from previous period less the depreciation charge in the current period, right? So here you can see that the carrying amount under the original method was 0 at the end of 2005. In the next 2 columns, let's calculate what Volvo should book in the past based on the revised useful life. It was extended by 2 years from 4 to 6. Revised depreciation charge should have been the opening carrying amount of 466,667 divided by 6, which is 77,778. Carrying amounts at the end of related reporting periods are calculated exactly in the same way as previously. So in these last columns, here are the differences between what was booked and what should have been booked. Now, when to recognize these differences or when to correct these errors? Well, as the error happened prior comparative period, which is 2004, we will need to split the correction into 3 parts. First, difference in the depreciation in the years 2002 and 2003 will be adjusted to opening retained earnings of 2004. So the entry is to debit accumulated depreciation and credit retained earnings in amount of 77,778, while that's sum of the differences for 2 years. Well, remember, we are decreasing our depreciation charges in the previous periods, so that's why the entry is not vice versa. The second part, difference in depreciation in the year 20Z4 will be adjusted to depreciation charge in profit or loss of 20Z4. But as we are doing this entry in 20Z5, we must credit retained earnings too. So the entry is to debit accumulated depreciation and credit retained earnings in amount of 38,888. Well, that entry is the same in fact as the previous one. Well, but it is very important to distinguish between comparative period and previous periods because you need to prepare your statement of changes in equity correctly and the other disclosures too. And we'll see that in a minute. In relation to 20Z5, you just book the revised depreciation charge fully to profit or loss, but be careful here because if you have already booked the annual depreciation charge, then make sure its total amount is correct. Well, here, let me add a small note. If you capitalize your depreciation to the cost of other assets like inventories, instead of recognizing it to profit or loss directly, then you would need to adjust your cost of sales and closing balance of inventory. Well, but let's not deal with that here. And also, don't forget to adjust your tax effect in the deferred taxation, which we ignore here. Let me quickly show you how it looks in the financial statements. In the statement of financial position, you simply present correct figures, but don't forget to write the word restated at your comparative balance sheet. In the equity, I show only the effect of the correction, but you don't have to do it separately on the face of the statement of financial position. It's okay to do so in the notes. In the statement of comprehensive income, don't forget to show restated depreciation charge for 20Z4 and mark the statement as restated. And let's see the statement of changes in equity. Here, you start with the beginning of the comparative period, and that's exactly why we calculated the effect of correction for 20Z4 separately from previous years. So, let's say that in the last year, 20Z4, you presented the opening balance of your retained earnings at 1 million, whatever it was, and now you need to present it after correction. Well, remember this difference, 77,778, as a correction of 20Z2 and 20Z3. Then you present the profit for 20Z4 separately. Again, here's the correction of 38,889 and the closing balance of 20Z4 separately. In the year 20Z5, you don't need to present any correction because you have already recognized the revised depreciation charge correctly. Of course, this is just the illustration, so you don't need to do it this way, but I just wanted to show you why you need to perform these calculations and where their effect is presented. If you want to download the handouts and the Excel file with these calculations, you can do it in my article on my website. The link is right here. If you like this video, please share it with your friends. I will very much appreciate it, or leave a comment below. You're very welcome to visit my site, ifrsbox.com, the place to be if you want to master IFRS quickly and have fun with it, and I know you do. Bye bye, and thanks for watching.